Hey everyone, and welcome back to the channel. Today, we're diving into a topic that can make even seasoned investors a little nervous. What to do when the Federal Reserve raises interest rates. It sounds complicated, right? You hear it on the news, and it often signals a bit of market turbulence. But what if I told you that these rate hikes aren't just something to fear, but something you can actually use to your advantage? Stick around, because by the end of this video, you'll have a clear, actionable game plan for navigating and even profiting from a rising rate environment. So, let's start with the basics. Why does the Fed raise interest rates? In simple terms, it's their main tool to cool down an overheating economy and fight inflation. Think of it like tapping the brakes on a car that's going a little too fast. Higher rates make it more expensive for businesses and individuals to borrow money. This can slow down spending and investment, which in turn helps bring prices back under control. For the average person, this might mean higher mortgage rates or bigger credit card bills. But for a savvy investor, it opens up some unique opportunities. One of the most direct beneficiaries of rising rates is the banking and financial sector. Think about it. Banks make money on the spread, which is the difference between the interest they pay out on savings accounts and the interest they charge on loans. When the Fed raises rates, banks can often increase the rates on their loans, like mortgages and business loans, faster than they increase the rates on your savings account. This wider spread can lead to higher profits for them. So, looking into well-managed banks, insurance companies, or other financial institutions could be a smart move. They often have a business model that's tailor-made to thrive when interest rates are on the rise. Now let's talk about your cash. In a low-interest rate world, leaving cash in a standard savings account feels like you're losing money to inflation. But when rates go up, cash suddenly becomes more attractive. High-yield savings accounts, money market funds, and certificates of deposit, CDs, start offering much better returns. This is your chance to make your safe money work harder for you. While it might not give you the explosive growth of the stock market, it provides stability and a reliable income stream, which is incredibly valuable when other parts of the market are volatile. It's a low-risk way to benefit directly from the Fed's actions. On the flip side, some sectors tend to struggle when rates go up. Companies with a lot of debt, especially those in high-growth, speculative industries like tech, can get hit hard. Their borrowing costs increase, which can eat into their profits and make it harder to fund future growth. This is why you often see a rotation out of growth stocks and into value stocks during these periods. Value stocks are shares of established, profitable companies that trade at a lower price relative to their earnings. Think of sectors like consumer staples, companies that sell things we need no matter what, like toothpaste and food, or healthcare. These businesses tend to have more stable cash flows and are less dependent on cheap debt to grow, making them a safer harbor in a rising rate storm. So, to wrap it all up, when you hear that the Fed is raising interest rates, don't panic. Instead, think like a strategist. Consider rebalancing your portfolio towards sectors that benefit, like financials. Put your idle cash to work in high-yield savings or CDs to capture those better returns. And finally, shift your focus from high-flying growth stocks to solid, dependable value companies. By understanding how the economic gears are turning, you can position yourself not just to survive, but to actually thrive. It's all about being prepared and making smart, informed decisions. Thanks so much for watching. If you found this helpful, please give this video a thumbs up and hit that subscribe button so you don't miss our next financial deep dive. Got any questions or your own strategies for a rising rate environment? Drop them in the comments below. I'd love to hear from you. See you in the next video.